Hi, so in this video we'll be looking at what we mean by a ledger account. So this will carry on from the previous videos, so do check those out if you haven't already. But yeah, let's just get into it. So we will have what we call an individual ledger account for each type of asset or liability, income, expense, drawing, or capital. So everything we have in our balance sheet, we can create an individual ledger account for every single one of these, and this is effectively so that we can break things down, and then at the end of an accounting period we can collate all this information in order to, well, establish what will go into our account. So the way we do this is we record each credit or debit corresponding to this specific type of, say, asset or liability in the individual ledger account. So below we can see an example of a very simple setup we can have for our ledger account. And as we see here, we write the debits on the left and the credits on the right. So let's say that this is an account for just some kind of asset. We can say like machinery. And in the previous videos, we were talking about, say, buying £20,000 worth of machinery with a bank loan. And we had how to remember what's a debit and a credit with our acronym DED-CLIC. So we could see that if we purchase £20,000 worth of assets, we can add this into our debits column and say we have 20k debited into our assets ledger account. And so that's all we need to do for this transaction. And of course, we would have a corresponding liability, a ledger account, liability account, and we would have debits on the left and credits on the right in this account. And this 20,000 would show up as a credit in our liability account. And so every transaction is recorded twice, as we've spoken about again in previous videos. And for every transaction, we have a debit showing up in one ledger account and as a credit in another ledger account. And so for a whole accounting period, we'll have lots and lots of transactions. So we might, for some reason, lose some assets. So that'll show up as a credit. Say we lose 10,000 in assets. Maybe we sell some of our assets off, or for whatever reason, the assets decrease, and we know that a decrease in assets is going to be a credit. So we do this for a whole period, and we can have thousands and thousands of numbers in our ledger account. And then at the end of the accounting period, we can just add up each side. So we've got, obviously this is very simple because we only have one on each side, but we've got, say, 20,000 and 10,000. So then overall, we've obviously had a 10k increase in our assets in this accounting period. So then we will carry forward that balance into the accounts. And similarly for liabilities, we'd sum this up and we'd have 20,000 in credits in this, and then we can carry that forward into the next period. And this balance carried forward is probably a topic for the next video, as all I was trying to do is give an overview of what we mean by ledger accounts. And that's exactly what these are. We just break up things into different things. So we'll have an income ledger account, an expenses ledger account, and so on, so that we can just record each transaction in these in order to sum them up, and we then get an overview of what's happened in our accounting period. So that's all ledgers are. It's just a way of recording things, and this is the sort of thing that we might associate with what an accountant does all day, is just adding up lots and lots of numbers for all these transactions. That's of course not just what an accountant does, but this is what people might think of as just adding up these numbers in the columns for all the debits and all the credits. So I hope that was useful as a quick introduction. Please leave a like if it was useful. Make sure to check out the playlist. Obviously we've used some past stuff from previous videos, so check out those and check out the future videos for more accounting concepts. And subscribe to add some econ to your subscription feed.